What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is July 3rd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about everything going on in the crypto market now. We not only need to talk about the current price action that's been playing out as we continue to test up towards our prior April relative highs, but on top of that, there's been a lot of hype around Gary Gensler potentially leaving the SEC, the Bitcoin ETF, and potentially getting rejected. All kinds of different things we got to discuss in today's video, as well as some really critical macro topics. I'm going to filter out the noise, show you guys the substance, and if you guys happen to enjoy this video, consider dropping a like. It's a great way to support the channel, and let's go ahead and kick off the rambling. All right, guys, I appreciate you guys and being patient here. I wasn't able to get out Friday's video, but I want to go ahead and try to play catch up here and talk a little bit about what's going on in the market. So for price action here, we have not seen any clear trend breakthrough. We had a pretty volatile day back on June 30th, and that was coming from some news in relation to the Bitcoin ETF. Now, as you all probably can read from the headlines, Bitcoin at the time was tumbling on a report that the SEC said that the spot Bitcoin ETF filings were inadequate, and they were pointing towards Fidelity and a whole range of other players that were basically copycatting what BlackRock was doing essentially, maybe with slight variations. Generally speaking, though, I know a lot of you out there are like, wow, Nick, you got this call right. You know, I had some people reach out to me and say, wow, like, okay, like, looks like the ETFs are getting rejected. At the end of the day, guys, look, as much as I've been calling that this is a kind of hype-driven narrative, there is a great chance, a overwhelming chance, that these will not get passed like they haven't gotten passed in the past. That's a tongue twister there. At the same time, I'm going to be non-biased here and let you all know here that this doesn't mean that I got it right. These, just because they are seen as inadequate right now, the SEC in many ways is giving a kind of hint or guidance that essentially the quote-unquote surveillance sharing agreements which have to do essentially with the exchange partner that the ETF filing is working with, in this case Coinbase, everyone switched to Coinbase now, was inadequate, or there wasn't enough details on how this program would work in order to make sure that there wasn't going to be price manipulation. That's been one of the big points by the SEC. Now, whether or not that is really what the SEC is concerned about, that's what this addressment was. And they didn't speak towards any particular filings. They kept it kind of abstract, and this does not give a positive or negative hint that any of these ETFs are going to get approved or rejected. So I would say that this is kind of a non-story. If anything, again, I'll be completely honest here that it's giving some hints to what the SEC wants to see if these ETFs are to get approved, right? So again, I don't see it as a negative event per se, but it again showcases here that this is not a slam dunk deal. Just because BlackRock has filed does not mean these are guaranteed to pass. So, I mean, again, can see this playing out here. Now, another thing that in relation to the SEC, I hate having to talk about this. There's been tons of people who are now citing that Gary Gensler is leaving the SEC. And that is not true. This has been something that, again, I don't even want to give AI any kind of PR here, or essentially any kind of like, oh wow, AI is so convincing or so powerful. But essentially, someone had generated an AI-generated article that was talking about Gary Gensler leaving the SEC. And essentially some crypto publications carried it, and now everyone is in the belief that Gary Gensler, whether he's being kind of forced out or he decided to leave, or whatever the reason might be, that Gary Gensler has left the industry. Well, this is, at the end of the day, it is fake news. It's not real. There's no substance to it. There's no confirmation. It is, if anything, a rumor. And I don't think Gary Gensler, in the heat of the moment, as he's really clamping down on the crypto industry, was just like, you know, I'm going to pack my bags and leave. If there was someone who wanted him out before, they probably would have gotten him out. So, yeah, again, at the end of the day, guys, there's nothing really going on here in this development. We will let you guys know if there is any substance to it as time progresses, but it looks like a complete farce. So, again, with what sounds like a lot of big headlines here, price action itself has not made much changes here. We are still facing resistance at that same level in April, the same critical level we've discussed for a long period of time, where we faced resistance back in May of 2022, and again, what was prior support back January to July of 2021. This is a critical level, guys. And while there are so many headlines out there, while there are a lot of people telling you you need to do X, Y, and Z, what we need to do is watch what price does. That's the best advice I can give you guys here. I know many of you are aware that we're leaning more in the bearish camp. There are many out there who are leaning in the bullish camp and think, whether it be this ETF or de-dollarization or maybe future banking crises, whatever, that Bitcoin's just going to rally to the moon and it's just going to be good like the old times, right? While I disagree with that, at the same time, I care more about what price is telling me here, because price tells me what Mr. Market wants, essentially. That lets me know what the institutions are going to do. If we can't clear through this level here, if we can't get out of this range, this is similar to back here in May of 2022, new resistance, not support. So if we can't, you know, keep in this channel for some time and actually get the foundation to move higher, then we're not in a new bull market. Right? It's as simple as this, guys. There is no other way to kind of, you know, focus on it or kind of have a perspective on it. If you're really sitting on the sidelines with cash now, you can ask whether or not we've really got the momentum to kick things off. Now, again, I'll be honest with you guys here. I'm definitely kind of keeping more open-minded that things might be moving higher, because we do have this blue flip here on our indicator. Albeit it's a relatively weak cross here, but nonetheless, as the pivot here, this is again a key version that you guys will get access to if you sign up for the Dash report. But essentially, for our momentum indicator, we have a version within the Dash report that has a pivotal line. So now it's easier for Bitcoin to remain in the blue flip here, because month over month, the price it needs to remain above is roughly around, if I'm getting it right here, around 28,755. So unless Bitcoin crosses down there by the end of this month, we are going to maintain the blue flip. And that definitely leaves me in a position where I'm trying to understand what the market sentiment is, if this is going to continue, for how long. This relief rally, whether or not you agree with me or not, has definitely been one of the most hated rallies by a lot of people. I don't really despise it or hate it, guys. I don't feel like I really missed out on anything. 100% in crypto is nothing at the end of the day. I care about making sure I've got all the tick boxes to make sure I'm ready to go long. And trust me, we bought ETH at $80 or $100 during the last cycle, right? During the last bear market lows, right? We timed the bottom perfectly on Ethereum and made multiples on our returns. And this is again why I want to kind of bring us back to center here, because a lot of people are still thinking in the mindset of the last decade. They're thinking about what they can afford to make, not what they can afford to lose. And I got to tell you guys this. I understand and I respect anyone who has a different opinion than me, those who are completely aligned with me, or somewhere in the middle. It doesn't matter where you guys are. I respect all of you guys, the different opinions, and everyone has different circumstances. So I thought I'd spend some time here today to cut out all the headlines about Gary Gensler and the SEC and whatever the new narrative is now, and bring us back to the macro, right? I want you guys to be very, very clear on one thing. I want to make one thing very clear. And I think many of you understand this, but I just, as a friend here, right, there's a lot of people telling you to go out and leverage trade. There's a lot of people telling you to go out and do X, Y, and Z. I want to tell you what really matters at the end of the day. And it's a bit of a boring thing, and it's a bit cold, but it's the reality. Right now, in this current environment, there are a couple different situations you can be in. Some of you, unfortunately, from the peak euphoria of 2020 through 2021, you've lost money since then. If you have lost money during that period of time, out of anyone, you need to be more cautious. You need to focus right now on priority, which is hedging inflation. And that is not going to be done through speculating on altcoins, trading through leverage, hoping that Bitcoin's going to go to the moon and buying here at $30,000. No, it's going to come from finding, short-term bond yields that you can hedge with, high interest savings accounts that are FDIC insured. And I know that that sounds boring, but that is where you need to have the majority of your capital. If you are worried about inflation at the end of the day, you have those avenues there that will hedge the bulk of inflation. If not, in some cases, if these yields continue to go up, outpace the rate of inflation as the Fed continues to hike rates. We'll talk about that later on. Even for those of you who made a lot of money over the last decade, if you were like myself, you were bullish during this secular bull run of the last decade from 2010 onward towards the 2020s, early 2020s, where there was just tons of opportunities, whether it be altcoins, whether in the stock market, it was in technology companies like the FANG stocks, semiconductors, whatever. You made boatloads of money, and you didn't have to do too much to make that kind of money, right? During this period of inflation here, it is important again to protect and preserve that increase of capital you've made. It is not the time to speculate, all right? And this is again my point here. It doesn't matter if you made a lot of money or if you didn't, all right, over the last decade. Right now is a time for protection. There is no scenario where it makes sense to take excess of risk right now, because we're in a high interest rate environment. We're in an environment where the Fed is on autopilot reducing its balance sheet. The ECB just picked up the rate it's going to be reducing its balance sheet. And while these forces may not be affecting prices right now, or maybe not even the next month, and hey, maybe we might miss another 3% move in the S&P 500 or in the tech stocks. God forbid Apple goes towards another green week to the upside. These are not the kind of things you need to be focused on, because all of those gains that came up so quick can fall just as fast. And all those dividends that a lot of stocks are promoting to you, they have a spot price, an actual value to the shares that can contract and make up any gains that you made through the losses in the principal price of the share within a matter of a few days. We've got to go towards something that's going to give us guaranteed returns. And that's why, again, bond yields are looking incredibly attractive. That's going to be a topic we're going to dive into here. Now, I want to go ahead and, again, just kind of dispel a lot of the crypto FOMO here. A lot of people saw ETH picking up here over the last couple of days into the start of July. We've seen essentially from those lows about a 6% move against Bitcoin, and that's got a lot of people all really excited about Ethereum. And again, we can see we've got a blue flip here for the first time on the daily since back in June. But I remind you all, take a look back, step back into those longer term time frames. We've continued to be red here since back in May. We had a temporary blue flip that did not hold like many of the prior blue flips since back in October 2022. We can see on the monthly time frame, which I think is the most significant, we have been red since back in February when we flipped. This is the longest red flip for Ethereum on the monthly since all the way back during the bear market collapse since in July of 2018 to May of 2020. So as we can see here, that Ethereum, even well into the bull market, right, for Bitcoin, was still holding at relative lows. We got in Ethereum at that $80 to $100 price tag. So my main point here to many of you is to not rush these things, to not rush getting into altcoins. Now, I understand the environment has changed for Ethereum, and I think that it's not going to come anywhere near down here. I think we're again looking for it to retest towards this range and test that long-term trend line, which holds major significance since 2016. So that's still another 20% discount from where we're at. Right? That's a great discount. And not to mention, if Bitcoin collapses during that period of time, right, or doesn't hold up past this resistance range, it doesn't kick off a new bull market, that's a 20% decline against Bitcoin, and probably much more in real nominal value when you're considering that both Bitcoin and Ethereum are probably declining and their dollar value as well. So again, it's not a major thing to rush into. Not to mention, altcoins, again, still continuing to lose market dominance here. Not a good sign. We want to buy when there's that huge capitulative wave where the four leading plays, Bitcoin, Ethereum, and stablecoins, make up the majority of the market. That means that there's ample liquidity for an altcoin cycle to kick off, similar to what we saw back in December of 2020. All right, so we're waiting for that environment here. We are not rushing in. The big thing I want to go ahead and talk about here, guys. I know some of you are probably like, all right, Nick, we get it. You have a negative sentiment in the market, but what's this talk about bonds? Aren't bonds kind of boring? Aren't they something that, you know, isn't really exciting? It's not going to make me generational returns. Yeah, it's probably not, guys. But here's the thing that's important to understand. I'm not even telling you have to go out and buy bonds, but you need to understand the macro importance here of what's going on with interest rates and why they do matter when it comes to asset prices. Let's take a look here. Right now, the US 30-year yield, for the first time in history, right? Really back here, and from the data we have to work with since the 80s, on the annual momentum indicator in 2022 saw a blue flip, which is maintained here in 2023. We saw the biggest acceleration in bond rates in the US 30-year yield throughout the last 40 years. Now, bonds to many people don't sound interesting as an investment vehicle. And I know some of you may not be convinced that you want to invest in bonds. That's fine. I'm not here to tell you guys just go out and rush and buy bonds. In fact, if you were to buy bonds, you wouldn't be buying 30-year yield, which is paying 3.8%. You'd likely want to go ahead and buy bonds for the 3-month or 1 month, which are paying nearly 5%, much closer to the Fed funds rate. But the key point I want to talk about is the dynamic between exposure to equities and bonds in the vast majority of portfolios and where liquidity is going to flow if certain variables continue to change. Over the last decade, bonds were paying a declining rate. But now, bonds are starting to pay a much more lucrative yield. Yields that we haven't seen since back during near the prior recession or the beginning of the last bull market, right? And not to mention, as I talked about earlier, you can take a look here at the 1-month yield. It's paying around 5%. So if your savings account is enough now you've got bond yields that are paying well above the CPI, right? The Consumer Price Index, or the measurement for inflation. If you believe those numbers aren't cooked, which I think at the end of the day they are pretty cooked, either way, the fact that you can get something that's paying you 5+% and looks like it's going to continue to pay you more, and earlier on in this year was paying up to 6%. Wow, it's a pretty good yield to get on something where you don't have to do anything. This is an important dynamic to understand, guys. And it's not that I'm just the only one thinking this. It's that a lot of institutional investors see this ticking up year by year, where back in the past, you earned nothing. You earned practically nothing on these bonds. No wonder everyone was speculating on equities, right? Well, now, equities are looking a little bit overheated, and we are still in that question of, hey, what's the technological innovation that's going to drive a new bull market? I know everyone's saying generative AI. Okay, fine. If you're sold on that, then you've got your narrative. I got to be honest with you guys. Generative AI is not enough to continue driving, traffic here. I'll give an example. ChatGPT's May statistics, this is the month of May, from April to May, had a 2% increase in visitors, monthly active visits to the website, down from I think around roughly 16 or 20% from the month prior, and the prior months where there was double or triple digit gains before. So that's the narrative here, that generative AI is going to save the market when ChatGPT, the leading application, only grew by 2% month over month. It's stalling already, guys, after just a couple months. It had a lot of hype initially, but there's not much follow through. So if that's the narrative, that's fine. Again, I can't at this point say anything else to convince other people. If they are convinced of generative AI, they're convinced. But for me, I know a couple important dynamics. We're going to need new market leaders in the market. Maybe NVIDIA is one of them, but there's got to be other plays as well. There's got to be usually multiple narratives in equities to continue driving interest. In the case of the last decade, there were smartphones, software, of course, built on top of those smartphones. You had advancements in semiconductors, biotechnology. You had the advent of social media, digital advertising, so many revenue avenues, e-commerce as well with Amazon, Netflix subscription services for content. I mean, you name it. There was just tons of applications. I didn't even get to list all of them just now. And that was what drove the secular bull in our last decade. I'm not saying we need to know all of them right away, but we've got to have a couple hints of these. I mean, all those companies that really thrived, they were publicly traded for a while. And if you were relatively keen on technology, you saw those plays like Amazon and Google and Netflix starting to come up. It wasn't so difficult to spot those stocks. And that's why the FANG acronym came out quite early. Or even when Facebook IPO'd, right? And after it went through a substantial climb, it's pretty clear that this was going to be a value play long term. Right? So you got to know what those trends are going to be here. Because if we don't have any of those trends, then bonds, as they're continuing to rise, are the worst enemy of investing in Bitcoin, the worst enemy of investing in altcoins, the worst enemy of investing in stocks, because you're debating whether or not to take a guaranteed 5, 6, 7% yield return on the safest asset in the world. I know some people would say it's not. It's used in the Sharpe ratio, which is the kind of guaranteed rate of return, right? If US bonds or treasuries are going to default or not go through, we've got much bigger problems here, guys. But again, at the end of the day, you have a generally guaranteed return of 5 to 6%, or speculating on equities in an interest rate environment higher than it's been in 20 years. Where the Fed is rolling off its balance sheet, continuing to contract the base money supply. I don't know, guys. If you look at, I know that some people say, you take a look at China, there's stimulus going on or whatever. If you look across the entire measurement for liquidity in the economy, it is contracting, guys. It's contracting right now. And along with that as well, if we take a look at the CME Group prediction tool, the Fed Watch tool, I know last month we didn't get an interest rate hike, but man, 87% odds of another 25 basis point hike. And we are only 3 days into July. We've still got nearly a whole nother month until the Fed FOMC meeting. If things in the short term keep playing as crazy as this, I think the Fed's going to have to put down the hammer and put in a 50 basis point hike. Maybe not in this meeting, maybe in the next. We'll see how things play out. I don't want to speak too soon, but guys, I mean, this is just going to bump up bond yields. Treasuries are going to start paying more. And again, I know some people think, the market's been stomaching these 75 basis point hikes and 50 and 25 basis point hikes, and Nick, the Fed's not going to go much further. Well, it's clear now that the Fed is going to have to, because financial markets are showing there's still too much money in the system, for one. And second off, like, even though stocks may not be directly affected, maybe the companies have strong cash flow and they'll be able to stomach having to pay higher borrowing costs on debt. It doesn't matter, because this is going to be paying higher yield on bonds. And therefore, the rate you will be able to earn on different forms of debt, whether it be government debt or commercial debt, are higher. And liquidity is going to go towards those sectors, not towards equities. And this is a big dynamic here. And this is why I come back here towards taking a look at the 30-year yield chart. What we had here was multiple decades of decline in overall bond yields. We are now seeing an expansion here. And during these periods of time, what you find is that defensive plays, if anything, are the place that people go to. But in most cases, that defensive play is not even an equity or a crypto. It is government debt, savings accounts, playing the predictive long-term game. I don't want to speak as if we can't continue climbing higher, guys. And I'm not saying that having some exposure to Bitcoin is a bad thing. We've been saying for months now. Unfortunately, some people just look at the YouTube thumbnails and headlines, and they don't make it this far in the video. We've said dollar cost averaging is totally fine. If you guys want a dollar cost average, having some exposure, that's fine. But know that a lot of these plays may take a very, very long time to come back. The dot-com bubble was a great example of this, how the bear market dragged on for 3 years. And again, along the way, can have many deceiving rallies, many periods of time where people thought everything was good, we're returning back to normal, and then we collapse further. And then we have another relief rally, and then we collapse further. And then there's another relief rally, and then we just collapse down and down. And I'm not saying we're in the dot-com bubble equivalent. I'm just saying it's a great model, probably the most realistic recession we can pull inspiration from. If anything, I would say the other one that we can pull inspiration from is taking a look at the S&P 500, the broader stock market during the 70s. One thing that, again, I think is important to highlight here is how we expanded towards new relative highs here during this decade, but we really didn't trend anywhere in the grand scheme of things. We went sideways. We had expanding lows and expanding highs. We could also pull great inspiration from this period of time here in the 70s and 60s, because as we went into this period of time, as inflation continued to play out, we weren't able to really escape into new highs here, well into the 80s here, right, when things started to contract and inflation started to come down. We need to get in an environment where inflation is back towards that 2% target. And if the Fed can do things right, and it stops pausing, and it stops seeing the lagging effects of its indicators, because we see that the moment the Fed pauses, consumer sentiment comes back up, right? Credit card debt expands, people start buying things, and it just makes inflation worse. It just kicks the can down the road and makes the unfortunate symptoms get to a point where they're going to be worse than they were before. We've got to make sure the Fed can step in and do the right thing, and essentially that asset prices, although they will be moderately cooled in the short term, will eventually have the foundation to continue expanding long term. That's what we're interested in. I gotta tell you guys, when I look at Bitcoin here, I'm not interested in the price action I'm seeing right now. Now, I know a lot of you are still left wondering, Nick, I want to be able to kind of hedge my wealth. There's got to be some other options outside of bonds that I can look at. And I think that that's very fair. It's important to understand that not just stocks and crypto are your only avenue towards hedging against inflation or being able to make some kind of return. There are also dozens of other markets, and one of them that has gotten really interesting but also accessible to the broader crowd that used to be exclusive to high net worth individuals is investing in wine. Now, if you guys haven't heard about our sponsor for today's video, WineChain, I highly recommend you guys check them out. WineChain is aiming to bring access towards the broader investor crowd, to allow them access towards investing in vintage wine drops that allow you to get exposure, not just to access wine if you're a personal wine connoisseur, but outside of that for the investment purpose as well, potentially making returns long term. Wine has been one of the best performing asset classes alongside art collectibles and different types of niche markets that, again, usually were only accessible towards a high net worth crowd. Now it's accessible towards a lot of everyday traders and investors. And they've already had a whole range of different drops here. They even have one going on right now here that you can participate, where there's only 25 drops for this vintage wine collection. And along with that as well, if you guys are interested to learn about how the storage process works, how everything works, we're going to be having an interview in the next video on Wednesday, where I'm going to be talking with Aubrey, who is heading up the marketing at the team at WineChain, where we discuss about the entire process about how WineChain actually works. And again, if you guys are interested, the marketplace will be dropping soon, where you essentially be able to purchase various NFTs on different wine drops, and this will allow you to actually have a claim on an exclusive bottle or set of different types of wine. Sometimes you can be buying one wine bottle or buying a collection. Depends on the rarity or the kind of expensiveness of these different types of wine drops. But again, I highly recommend you guys check it out. I'll leave a link down below in the description. But they're definitely a project that for me, I think is quite interesting because they utilize NFTs in a real world use case, and it's using it to access a market that again used to be closed off towards a very select crowd of investors. For me, that's very interesting. It's democratizing investment opportunities and allows you to start diversifying and looking for alternative opportunities in other areas, which is right up my alley as a macro trader. Anyways, guys, that's it for today's video though. I just want to go ahead and close things off here. Again, we will continue to watch what Bitcoin does here. I do not want to speak in absolutes, but when I see this price action here, I'm not seeing the ability to clear through that resistance mark. I'm sticking to my guns here, guys. We've got to be cautious here. We've got to be patient. And if we do any dollar cost averaging, keep it moderate, right? This is not the kind of price action that gets me really hunky-dory here about going all in on Bitcoin. And let's wait and see if some of those narratives hold up, because we sure saw de-dollarization didn't hold up. We saw the banking run narrative didn't hold up. Stablecoin liquidity in this space right now, again, continuing to be dry right now. If we just take a look at the chart, right? No expansion in new stablecoin liquidity. This looks disastrous, guys. That's not me being negative here. It's just the reality. We have not seen any expansion in new liquidity into the space. So we better hope that the ETF narrative holds up, because if it doesn't, we're in another distribution pattern here for Bitcoin. That may very well be the reality that we are facing right now, but time will tell. Well, guys, if you liked my rambling here today, consider dropping a like. It's one of the greatest ways you guys can support the channel. I hope you guys have a fantastic day wherever you are, and I'll see you all in the next video. Take care, everyone.